Do I have any currency traders here? Who are liking the Forex? You liking the Forex? Yeah. Right on. He's a best Forex trader in the whole village. He don't trade the potassium. He trades a currency. All right, so it's a Monday, April 27th, 2015. My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com. Join me every day at 7:30 in the morning, Eastern Time, Wall Street Time, otherwise known as London Lunch, Monday through Thursday, and then every Friday at this time I'm at fxstreet.com. So every trading day I'm here for you. Because we're all clients of Traders Way, we are able to trade Forex, energies, metals, indices, and binary options. And typically, I try to cover all of those in any given strategy session. However, today is a Monday, and I propose we go through the calendar. All right, here's one. I propose we go through the calendar, and we also go through the Commitment of Traders report and identify the change in large institutional positions, and then have our week planned out, and then call that a day. And tomorrow we'll just do technical analysis, technical analysis, technical analysis, technical analysis. All in favor, say aye. Or I suppose all in favor, type aye. Yeah. Rick's like, I've been saying aye, but nobody. All right, awesome. All in, we're going to win. Check it out. Here we go again. For trading and investing is risky, not appropriate for everyone. Your past performance, good or bad, is not indicative of future results. So always stay small and stay humble. Focus on the long term. Never risk money you cannot afford to lose. What do you want to start with, calendar or COT? Anyone like chewing on their fingernails with nerves? Traders report. Well, all right. All right, well done. Only one person voted. All right, can you see that all right? All right, what more do you want to know? Hang on. I was just going to see if I could do something here. No. Someone requested that we use a little larger font in the chat. So I'll try to do that as well. We'll see if that looks pretty big. But anyways. All right. Okay, so here we go. This is Euro. And what we're looking at here is Euro USD, because they're based on futures contracts, I believe at the Chicago Board of Trade. And so these future contracts, currency future contracts, are priced in dollars. Okay, so this is the Euro USD futures contracts, priced in dollars, therefore Euro USD. You can see right away the red line in the middle. Chop, 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 chop. That is the Euro USD. Okay? And this is where we are as of Tuesday of last week. Okay? So you can see it's pretty updated. Right? Just a little less than a week. This report is made to you by the Commodities Futures Trading Commission, the CFTC. It's provided to us on Friday after the market close, and this data is of Tuesday of last week. So you get it. It's compiled basically on Wednesday and Thursday, and given to us by the government on Friday. So it's not that bad. It's not that old. It's not real time, but it's not that old. I provided a link on one of our CFT videos that I've done in the past, so you can go to youtube.com/c/tradersway to get to our channel, and just check out, go back a few weeks, just sort through the Monday videos. It might even say Commitment of Traders Report in the title, and in there, someone asked for the link. Where exactly do you download it? It's a downloadable Excel spreadsheet, and I think they also have a PDF where you can get this data. Okay. So anyway, so you can see it's pretty up to date because you probably know the price of the Euro USD, and it's not, we're about there. Okay, good. We also want to look at two things, right? The longs, the shorts, and I guess the third one is the net. Okay. So this line here are traders going short Euro contracts, basically short Euro USD. Okay, you see a rise, slight rise, nothing dramatic, but a slight rise in shorts. There are more short positions than the week before. Okay, more shorts. More means more selling. The gray line are longs, and it's just ever so slightly, just tiny bit higher than the week before. So tiny bit more short versus tiny bit more positions long. And you can see here the net, which is the black line now, just ever so tiny more people short, because this is what it's doing, right? The longs, right, plus the shorts, which is a negative number. Well, more shorts, so whatever. You add them together, and here it is. The market is just ever so slightly more bearish than before, than the previous week. Well, this was important because we wanted to see if this was profit taking, or if the trend is over. Okay? So that's very, very important. And it seems to me that our downtrend is not over, according to this information. Okay, that's the most important use of this information. Okay, British pound. Okay, again, we've been asking ourselves or asking the COT for confirmation of our guess. Now, remember, in February, and early March, we were talking about just maybe the middle week, right? The around the 15th of April, if we would get a change from bearishness in the British pound to bullishness in the British pound. Then, on that week, the middle week of April, we did get a bounce, set up with an inverse head and shoulders pattern. Okay? And then the following week, sure enough, higher highs and higher lows. But is that, in the eyes of the long-term institutional speculative traders, is it a reversal of them? Well, let's take a look at how their positions are. Because remember, these are large positions. The positions are so large, they must be reported to the government for like systemic risk reasons, right? So a slight increase in long positions, but look at this, dramatically less people in short positions. Which tells me, first of all, the upward move in the British pound versus the USD is legit. Right? So our combination of fundamentals and technicals have been excellent. Thank you. But it also tells me the up move hasn't even really begun yet. Or if you're a bear, somewhere along the line, this is going to turn bearish again. So it comes down to what you believe. Okay? Because no one's going long yet. So there's two schools of thoughts. After you get a nice little Fibonacci retracement on the longer term charts, more people are going to go short again. Or, you know, and this is kind of what we're looking for if you're a bull, each week we want to see if there's a dramatic increase in long positions. Okay? So we're not quite there yet. I wouldn't call that a dramatic increase, but that's definitely a dramatic decrease in short positions. And the trend over 1, right, 2, 3, 4, 5 weeks is dramatic down trend. Dramatically less people short. Right? So very nice. I want to take a vote here. How many people are bullish British pound on the let's say the medium term over the next month or two, and how many people are still bearish? Type it in. Let's see, guys. Typical. It's amazing. Over all these years that I've been doing live webinars and stuff, when I ask that basic question, are you a bull or a bear? No matter what the scenario is, no matter what the technicals are, no matter what the fundamentals are, no matter what the trend is, when I ask, it's almost always exactly 50-50. That's what the market is. Amazing, right? I would be a bull. I believe the worst is over in the UK, and the Bank of England is looking forward, not backward. That's my opinion, but anyways. So yen. All right, check it out. Less bulls, less bears. Or sorry, less bears, less bulls. And dramatically less bears, slightly less bulls. What's that called? That's called a sideways market. And in fact, we've gone from heavily net short to neutral. So if you expect USD yen to go somewhere dramatic, you're hoping or betting, or even worse, delusional. Now, I've been talking about this market having the potential to move sideways for 4 or 5 months. Can anyone confirm? We were talking about that from the sort of the reset in yen strategy occurs on April 1st. But anyone remember me discussing that? In fact, it happened last year. This year is different, but it is definitely plausible, and that you should be emotionally ready for it. And that we're in this scenario where you need to make a decision. Now, I don't know what the right decision is. And whatever your decision is, based on your type of trading strategy and risk tolerance and stuff, both are basically right. It just depends on what fits your risk profile, right? One of them is shoot at rabbits for quite some time. What I mean by that, if you can pick up 25 or 50 or 75 pips on yen trades, you should probably do it. Or the other one is build a portfolio. So you buy at the bottom. Remember, you can't buy at the top. Only buy at the bottom. And every time it comes back to 119. Every time it comes back to 118 kind of thing. You buy at support, maybe hedge with a binary option. Okay, so you buy at support and then use a binary option to hedge. So So you sell with a binary to remove about 40% of your risk. It's just an policy. And then if it does indeed rise, jam your stop at break even, you don't take profit. Yeah, seriously. You don't take profit. You just assume you're going to be in this trade till the end of the year. And if you get knocked out, well, you have the opportunity. Okay? And if the market does go up like your fundamentals expect, and that your fundamentals would have to believe that, then you're in. And so if you bought at support, hedged with the binary, and then of course now your binary cost you, a certain amount of money, so you want to cover that in your stop loss. So really your stop loss might be plus 20, but you would move it when you're like plus 100 kind of thing, right? But to cover all your costs and lowering your risk and all that, for all intents and purposes, it's break even. I like mine to be minus 1 pip. If I'm going to lose, I want to record it as a loss. Because therefore, if you look at all your winners and losers and you look at all your averages, you want to really know which ones actually were losers. So I want to record it as a loss. If I didn't make money, it's a loss. Like some people will move it and get plus 1. And they're like, oh, but I made a pip. Well, who cares? Come on. Who are you trying to fool, right? Oh, but my winning average is so high. Nobody cares about that. Okay. But if I move it to minus 1, it gets recorded as a loss, and I understand that what was happening. Plus now my average loss is significantly lower. So let's say I have a bunch of losses that are minus 50, minus 80, minus 30, and then I have a lot that are just minus 1, minus 1, minus 1, minus 1. Well, then that average is low. And then when my winners are winners, they're all plus 50, plus 80, plus 100, plus 200, plus 300. And now they're all, and I'm not diluting them down with little plus 1s. I'd rather dilute down my losses than dilute down my winners, right? So anyway, so what in that strategy of portfolio now, if you're looking at a portfolio management type strategy, you would enter in, hedge it once it's profitable, move your stop to cover your costs, and then you leave it and you literally get out till the end of the year. And it goes up, let's say 100 pips, and comes all the way back down, or almost all the way down. Instead of 119, maybe it's 119.50. And then it starts to look like it's going to go up again. Place another long, completely different trade now. Hedge it with a binary option, rinse and repeat. It goes from 119.50 to 150, and you move your stop, cover your cost, and you're in. And your plan is don't get out of that trade till the end of the year. So like now, let's say it's July, and it comes back down, knocks out your one at 119.50. Okay, you're out. You didn't lose anything, but you had the opportunity, and you picked up, a millionth of a percentage of interest. But maybe it doesn't take out your first one, and then goes from 119.50 for the second time and goes all the way up to 122. Well, then the one at 119 is still profitable. But every time it comes back, you're just treating the new scenario. You wait till it comes back to hardcore support. You wait for it to be oversold. You wait for it to, on small time frames, make reversal patterns. So you're still entering everything the same, but your risk management strategy is different. And you just, so when it does break to the upside again, if it does, you might have 5 positions open. And all of a sudden you're making 100 pips a day as it goes from one, you've seen it before, right? It goes from 120, all of a sudden it's 121, 122, 123, and in 3 weeks, or sorry, in let's say in 1 week it's moved 300 pips. But you're in 5, now you're up 1,500 pips, okay? And you're still, now you get the trend and all that kind of stuff. So that's one way. The other way is what I'll do is I'll throw down like a 2550 OCO, and I'll look at it and say, look, we're moving sideways. The average daily range has dropped from 125 down to 75. So if I can pick up 50 pips in a 75 pip average daily range, that's the vast majority of it, and I'm tickled pink. I don't mind taking 2/3 of the ADR. and putting the money in my pocket. Okay, and then last, just for food of thought on this one, food for thought. You shoot at rabbits now until, let's say, the second or third week of July, and then you switch from, trapping rabbits to, setting up positions for bigger game. Okay? Which one's right? Both right. Okay? Oh, so Oren says, is it better to buy other yen? Yeah, to me, it's all the same thing. All right, let's talk about that for very, very a brief minute, a brief moment in time. All right, so in my chart setups, obviously I trade a lot of different pairs, but you'll notice I have a lot of different setups too, like scan Swissy, scan Euro, scan Pound, scan Yen, scan Dollar. Why do I do that? Well, the reason I do that is when I trade, I tend to trade in a correlated fashion. So one of the things I'll look for, so let's pick the dollar here. One of the things I look for when I trade is a correlation amongst all the pairs. So at the top here, you'll notice that I have pound dollar, euro dollar, Aussie dollar. The US dollar is all on the right. And on the bottom, I have dollar Swissy, dollar yen, dollar CAD. The US dollar, in this case, they're all on the left. What I'm looking for is correlation. So on days that the dollar's strong, the top pairs should be falling, bottom pairs should be rising. Okay? Double check they're all in the time frame. Yep, see, they're all 15-minute chart. Okay, so what it tells me a couple of things. One, it's a relative strength exercise. So if the dollar is strong, it looks really strong, but not against the Aussie and not against the CAD. So what does that tell me? Generally speaking, dollar is strong, except against these commodity currencies, they're even stronger. Now, Aussie dollar is doing almost nothing, so the Aussie is, roughly speaking, or almost exactly, the same strength the US dollar. And that the Canadian dollar is even stronger than the US dollar. So now I could say, if I wanted to sell yen, I could long CAD yen first. And then maybe consider Aussie and USD yen next. Because right now, I look at this, Canadian dollar is the strongest. Done. Look, it takes me a half a second. Canadian dollar, probably will buy Canadian dollar. Done. Just on this time frame, right? But what I would really like is to ask myself, am I buying US dollar or am I selling US dollar? And when I see, let's say, dollar was strong across the board, then I could say the US dollar is the strongest currency on the planet. I'll set my tone for the day, right? Sort of like Mike's flip of the coin. Dollar strong. I'm going to, buy dollar at I'm going to sell dollar at dollar pairs at resistance kind of thing. I'm just going to buy dollar for today. And then if there's one slightly, different than the others, then it'll tell me if it's strong or weak. Okay. And so, anyways, on any given day, I'm usually buying dollar across the board or selling dollar across the board, and I do the same thing for the yen and pound and euro and stuff. My next favorite currency pair to trade, okay, in my book, it's US dollar, right? I say if you're going to specialize in anything, start with the dollar. Become a greenback guru. I put a whole, section of my book on that because, typically, when you meet a newer trader, they say, hey, Wayne, what currency pairs should I be trading? Well, you shouldn't be trading more than one because you're not that good. You don't understand correlation. You don't understand relative strength. You don't even understand what impacts all these different currency pairs. You're a mess. So you need to specialize in something, right? You want to learn technical analysis on one pair, and you should learn fundamental analysis on one currency, and that would be the US dollar. So if you were going to do anything, like maybe just trade the Euro USD, but then specialize specifically in US dollar. Learn about macroeconomics in regards to the US dollar, microeconomics in regards to the US dollar, learn everything you can about Fed and Fed policy, but so that you understand about US dollar, and then just focus. Don't worry about everything else. And then next year, maybe start learning about Eurozone the ECB, or whatever, and slowly become an expert in specific areas. Right? Think about how the world works now. Who makes more money? The jack of all trades or the guy with 2 PhDs? And by the way, I've met people with 2 PhDs. I've met people with 2 MBAs. I mean, I don't know why, but we live in a specialized market. So specialize in something. So I suggest Greenback Guru. Anyway, now I go over to the yens, and I have this type of setup, or I have yens with pivots, and I do this for the US dollar as well. And what I'm again looking for is correlation and relative strength. Okay. Okay. And not just against one, but against many. Okay, I have to clean these charts up, but okay. So very often, like recently, I noticed Jenny's been asking when I cover pound yen. Jen usually immediately says, "Can you do it for pound dollar, pound dollar?" Well, to me, it's the same thing. Because if I'm trading a yen, right? Generally speaking, if I want to sell the Japanese yen, let's say, what was I covering before? I can't even remember. If I want to buy the pound yen, I want to buy the Aussie yen, CAD yen, Euro yen, USD yen, Kiwi yen, South African rand yen, Turkish lira yen, just whatever. And I start making the buying decisions because all I've decided really is to sell yen. Then the next thing that happens is if I'm going to sell the yen, which one am I going to buy first? Which one am I going to buy second? And that comes down to relative strength. Okay, and then preference and all that kind of stuff. But if I've decided to buy the pound yen, well then that means to me the pound is reasonably strong. And in almost all situations, if I've decided to buy the pound yen, then I'm either going to buy the pound dollar or not buy the pound dollar, but I certainly couldn't sell the pound dollar. Okay? If I looked at your trading and I saw today you were selling pound dollar, buying pound yen, I would look at you and say, you're a complete mess. You're a disaster waiting to happen. And I've said that to traders. I'm like, someone that reviews your trading history should look at it and understand what you're doing. It should make sense. When I read your trading history, it should be like a pianist reading sheet music, and they should be able to hear the music just by looking at your notes, right? So I should see if you're, let's say, short the Japanese yen today, that you're let's say long CAD yen, long pound yen, long US dollar yen, and I say, okay, good, short the yens. Good. If you're long pound yen, you're either long pound dollar or you're not long pound dollar, but you cannot be short. You're either long pound Swissy or you're not long pound Swissy. Right? You're either short euro pound or you're not short euro pound. But if you're long pound, you're long pound. And if you don't have the correlation, then you're just either guessing or you're a degenerate gambler or just amateur up the yin-yang. Right? So make sure you understand what your strategy is and make sure you're able to explain it. And your trading results, or not even results, the trading history should make sense if someone else was reading it. Oh, Kevin was long pound today, or oh, Jenny was short Japanese yen today. Okay? Oh, short the dollar today. It should make the rest, so that's called correlation. And you'll see intermarket correlation. For example, very often you'll look and you'll see Kiwi strong, CAD strong, Aussie strong. Right? Norwegian krone along. Why? Commodities, the commodity market is probably strong. And therefore, that impacts the value of commodity currencies. Okay? This is important. So you have, you have intermarket and then intramarket. Intermarket would be, you're just looking at the yen pairs. Okay, the yen is weak today, risk on, risk off, whatever. Okay, sometimes it's intramarket outside of just the currencies. Commodity, gold is up, oil is up, copper is up, coal is up, iron ore is up, whatever, right? Lumber is up, beef is up. Okay, commodity. Dairy. Remember, New Zealand's biggest export is dairy. So when dairy prices are up, the Kiwi dollar is up. No joke. And sometimes within 1 second of that, I believe it's on Tuesdays, the dairy auction results come out. Boom, 1 second later, Kiwi changes value. So that's intramarket. So all these things are important. Okay? And so on a day where commodities are up, I don't want to see you long CAD and short Kiwi. Unless Kiwi is short across the board, or, but it shouldn't be, but sometimes, other things are happening, or CAD is strong across the board. But it seems to me I would start with, if CAD is strong, I would probably start with, let CAD yen long and USD CAD short. Because the other thing is, and here shows more of the sort of the chaos theory, which is discernible pattern in large data sets. That so it looks like chaos, but it's not really. Very often you'll find in a risk on, risk off world, if the US dollar is strong, the yen is strong. If the US dollar is weak, the yen is weak. The reason for that is Japan and the United States have by far, and I mean by far, the most mature bond markets in the world. And this is important because when globally speaking now, if it looks like the world is nervous, then they tend to move themselves out of riskier, higher return assets into less risky, safe assets like bonds, right? So we know that the common, everybody knows, let's say, if the stock market's down, the bond market's up, inversely correlated, right? Well, that, just imagine if the nervousness is global, let's say terrible Chinese industrial production numbers that just confirm that Europe is still in trouble and that the United States is slowing down, like really bad, right? All right, you'll tend to see globally stock markets fall around the world and bond markets rise because the money is flowing out of bonds, out of stocks and into bonds. And that's called risk off, risk aversion. Okay, money is flowing to safety now. And guess what? That money could be flowing to the United States and flowing to Japan. So on that particular day, money from all around the world is tending to go toward the safe havens of the Japanese bond market, JGBs, and US Treasuries. And safe haven assets, you need those local currencies, and therefore they get strong in risk-off days. And all of a sudden, US dollar is strong and Japanese yen is strong. 3-4 days go by, the world realizes they're just panicking. Oh, it's all good. There's a way to explain your way out of this. And all of a sudden, money moves out of the bond market back to the stock market. Money flows out of the United States. Money flows out of the yen. Now, remember, is it American money leaving? No, not really. I mean, it's U.S. dollars, but U.S. dollars that were purchased to purchase the safe haven assets. Now, if those investors get out of the safe haven assets, they're going to sell their dollars, sell their yens, and then put it back wherever they wanted to put it in the first place. Maybe it's back into iron ore. Maybe it's a stock market somewhere else in the world. Whatever. That money flows out of these safe haven assets, and suddenly on the same day, for really the same reason, U.S. dollar is weak, Japanese yen is weak. Okay, and there's correlation there. So, long story short, if I'm thinking about buying pound dollar, I'm 99% I'm buying pound yen. And if I don't want to buy pound yen, I'll be extremely nervous and probably not buy pound dollar. Because I'll say, ooh, well, it doesn't look so good over here, so I don't have the correlation. So I need to really understand, right? I really need to understand why I'm taking the shot. So, you know, I start with correlation first. So these are yens. I want to see every single one of these up, 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 up. Make sure they're all in the same time frame here. Okay, see they're not. Okay. And if they're all up, then I'm going to be selling Japanese yen across the board. Then the second one is which one's moving up faster and which one's moving up slower. So obviously I want to take the ones that are, and you know, let's say typically I'll do something like I'll start with the USD yen, and then I'll buy the pound yen, and then I'll buy the CAD yen, and then I'll buy the Kiwi yen, and then I'll buy the Euro yen, and then I'll buy the Aussie yen. So if it was a really busy trading day, I'll buy one, move the stop, buy the next one, move the stop, and look at it more from a portfolio of I'm short Japanese yen versus everything, and I tiptoed in based on which currency versus the yen is strongest, which currency versus the yen is second strongest, which currency versus the Japanese yen is third strongest, so on and so forth. So start with intramarket and intermarket correlation, and then follow that up by relative strength. So lastly, you enter with technical analysis. So if I said today I want to buy USD yen first and then save the other ones for later, then I drop into the USD yen and I start looking for support and reversal patterns on small time frames and enter in just the same way technically. Okay? And if I don't have the correlation, like let's say this place was a mess, like USD, see Euro yen here? They're both weak. And I say, well, you know, what if one was going down, the other one's going up, and half of them are sideways? You know what I say to myself? And it usually takes me less than 1 second. I'll open it up and I'll go, I don't want to sell yen today. I don't want to trade yen at all today. And knowing when not to trade sometimes is more important than knowing when to trade. So Jenny, two favorite currency pairs the vast majority of the time. US dollar, Japanese yen. I start with the dollar, I go with the yen. Now, you know, for example, when Governor Stevens says the Aussie dollar is going to fall 1,000 pips, and he's done it twice for us now, suddenly I'm like, sell the Aussie versus everything. I wake up in the morning, sell the Aussie, blah, blah, blah. Or when the euro's coming down like a ton of bricks, okay, now it's pretty easy. I'm like, I want to sell euro today. Okay, so it depends what's going on fundamentally. But like 2 years ago, something like 1/3 of all my trades was pound Aussie. The pound was ripper strong and the Aussie was ripper weak, and it was just a perfect storm. And all of a sudden, just the vast majority of trades were just selling Aussie, buying pound for the whole entire year. And then how about selling euro dollar? I mean, that all of a sudden that takes over. Okay, that's sort of the fundamental theme of the moment, which to me usually lasts a year, right? So there's the fundamental outline, world. But if you look at my trading over 10 years now, right? You could almost define me as a dollar trader and a yen trader over the course of 10 years. On the course of 1 year or 2 year, well, the fundamentals shift all the time. So it'd be dollar, yen, and whatever, the flavor of the year, right? So as the euro dollar gets closer and closer to parity, there's less and less likely it'll continue down. So, I think we hopefully will break parity and go even lower than that. And then we'll have something else to do. Okay? And in 2 years, we'll probably buy that euro right back. But that'll be the flavor of that particular year. Not this year, and probably not next year, okay? All right, well, there's the answer to Jenny's question. That was only, what, 30 minutes? But, hey, look, if we're going to discuss something, let's go all the way. Right? My goal isn't to be brief. My goal is to transfer knowledge. So if that takes 30 minutes, so be it. All right? So thank you for the good questions. Japanese yen, so we're closer to neutral. You have a couple of choices there. Aussie, well, you know, all these things probably haven't changed, but we'll just look at them briefly. Okay. Quite a bit less, a significant drop in people short, no change in people long. So, Aussie dollar goes up, as you can see, Aussie dollar goes up. What does this mean? It means the farther it goes up, the more likely I want to sell it. That's what it means to me. Okay, until something changes. That's what that means to me. Kiwi, now the Kiwi's been on a beautiful rally, right? Is it going to continue? Well, as of last week, okay, it's been dramatic, right? We went from net short to neutral, but look at the moves, guys. Boom! On the week we break neutrality, it's unbelievably dramatically bullish. And now it's been 1, 2, 3, what is that, 4 solid weeks of up. Dramatically less people short and significant more people long. That is a full-on, fundamental, as pure can be, change in trend. Remember, these are not opinions. This is based on billions of dollars going from bear to bull. It's not insignificant. So you just said that euros expect to go down in the future, then you would expect... No. I didn't say anything about a correlation between euro and pound. I discussed correlation between dollar and yen. And if I'm buying pound, I'm going to buy pound. For today, let's say I'm buying pound, or this week, or whatever, if you're a spot trader or swing trader. But if I'm buying pound, I should be buying pound against everything. Okay? If you think euro is going to go below parity, then you should sell euro against everything. Okay? But if I see you short euro USD and long euro pound, then you're a mess, because you're buying euro and selling euro at the same time. No. Okay? No. So, like, what I'd like to see, Jenny, is, let's say I looked at your trading for whatever time period, and it just says, I look at it and say, oh, Jenny's short the euro. Or, oh, Jenny's long the pound. But if I can't tell that, then how am I supposed to figure out your strategy? And if I can't figure out your strategy, then how do I know as an investor that you fit in my portfolio? Right? So, obviously it couldn't. Therefore, you'd be a terrible investment if your trading doesn't make sense. And you know, it's very interesting. When I see beginning traders, they don't think that way either. They're just trying to make as much money as they possibly can. Look at all the pips I made. And they don't realize that the next step is they need a sellable story. That's probably something I'm going to put together in a book some year, whatever. But you know, when you meet with an investor and you say, oh, look, I made a bunch of pips. Nobody cares about that. Well, good for you. Oh, well, you should give me lots of money. Well, I got a lot to discuss before I give you any money, right? Let's look at your risk-adjusted performance. Let's look at your trading strategy. Let's look at, because I need to know if you fit my portfolio. Right? Like, what is it that you do? What's your outlook for the next year? Well, I don't really do fundamentals. I just look at technicals. I have no idea what's going to happen next year. But look at all the pips I make. I'm like, well, that's good for you, but I need to know if you fit in my outlook, because I have a portfolio of stocks and bonds and hedge funds and commodities and real estate and all this kind of stuff. I'm a complicated person, and I need to know where you fit in my business. And if you don't know what you're doing, then, well, I can't make a decision. So I'm just going to look at the other 100,000 people I can choose from. What's your sellable story? Oh, right? Oh, whatever. I think the Japanese yen is going to be super weak between now and 2016 based on all this evidence. So I'm going to look to sell Japanese yen and buy yen pairs on all the backs. Oh, sweet. Well, let's talk about your risk-adjusted performance. You're like, oh, well, that's actually a really good question. To minimize the overall risk in the portfolio, one of the things that I like to do is use binary options to blah, 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 blah. Therefore, you get a low beta, blah, 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 blah. And all of a sudden it sounds really good. You're like, man, I don't know what you just said, but you sound really smart, so here's my money. Which is a lot better than, I don't really know, so I just wing it. But I make a lot of pips. Who cares, dude? All right. Let's wrap this up. Okay. Big drop in price. USD CAD. Fine. Long positions. Whoa! Holy smokes! Look at the long positions. That's a big jump. And then, wow, a lot of people also got out of their shorts. A lot of people went long. A very small change in the net, right? The net positions. But what? More bulls than bears. But it looks neutral. When you get something like that, a dramatic increase in longs, dramatic increase in shorts. They offset each other. Volatility is high, but the market's not doing anything or shouldn't do anything. And so I'm a little bit concerned that it could move sideways for a while, right? Now, I just want to bring this chart up because we know it's been moving sideways, but we have a technical plan of sideways, breakout, retracement, continuation. And then we got to do the calendar, yo. Okay. And it's now, this has been, what, 2 weeks now? It's looking all right, okay? Now we need it to get through this lowest low, okay? How does that work? You get the breakout of this low, drops, obvious support, back, retest what used to be support, now resistance, and hopefully, just hopefully, it now makes a lower low, lower than this low. Okay? Be the fundamentals confirming the technicals. Or the technicals confirming the fundamentals, whatever order you want to go in. Am I doing that, Kevin? You got to keep me in line. So, I mean, that's not necessarily a good thing. But at least I have all the levels. So, you guys are the boss. I'm here for you. I want to help you. So just ask if you need something, right? So like Jenny asked for something, and I delivered a lot of information. hopefully everybody got something out of it. And if it's over your head, ask or tell me. Yeah. All right, cool. And that, you know, I thought that would be my next book where because the idea is if I've spent 10 years helping people, let's say, get beyond break even, learning the basics of technical and fundamental analysis, then what's missing in the market is, well, what do you do then once you're profitable and you want to trade other people's money, like through a managed program or through a hedge fund or whatever, become a CTA, whatever, right? Now what do you do? Well, you know what? It's a whole different gig. Getting regulated, being regulated, raising money, doing your DDocs, doing road shows, and all this kind of stuff that I've spent years doing. They're like, well, now what do I do? I'm profitable, Wayne. I have 2 years of profitable trade history, and I want to trade other people's money. Now what do I do? Well, let me just tell you, trading profitably is the easy part. Right? I mean, trading the money profitably, I mean, that's the easy part. All right, so anyways, we need to go through the calendar. Okay, this is a busy calendar. Let's filter this sucker. 3 stars only, otherwise it's not worth our time. All righty. Beep. All right. GDP out of the UK. You know, typically I don't care that much about preliminary GDP because what happens is it gets revised. But what has happened with the British pound recently? And I mean in the last 10 days. Looks like the birth of a reversal. Now, not quite confirmed yet based on COT. Because not enough people are going long. But we talked about this earlier. You know, I asked back in March, I said, look, in April, middle of April, this would be the catalyst for smart money to go along British pound. And I said, the smart money, like you and I are smart money, we were talking about that in March because we actually listened and reviewed the notes, right, from the meeting minutes and stuff, from Carney at the Bank of England. And Carney said, hey, the stats are terrible, but don't worry about it because the inflation's really there. We know the personality of Carney, who runs the Bank of England. We know his personality is that he tells the God's honest truth in his mind. If he says, don't worry about it, he honestly means don't worry about it. He doesn't deviate at all from what he honestly believes. This is the guy in charge. But nobody does that, actually read meeting minutes and attend the press conference and stuff. But that's what he said. Then we surmised that, well, then smart money is going to need to confirm that using the IMF report, and that wasn't going to be for another 6 weeks. But you know, so we go to the IMF website, find out that it's the 13th of April. So therefore, we said, well, maybe in the middle of April, when that IMF report comes out, that'll be enough to confirm the people that are paying attention to what Carney is saying. But before they believe Carney, they need someone to back them up. That was the first opportunity for anyone to back them up. So not bad news is going to be relatively good news. Okay? So normally now, so now anyways, we get the inverse head and shoulders pattern. Technically, people go along. It's been up for 10 days, and a lot of people are surprised, and we knew it 6 weeks before it happened. Okay, great. Now what? Everybody needs a new thing, right? Past performance does not predict future results. So if you were a genius 6 weeks ago, well, great. You need to be a genius this week too. So now what, genius? Normally, GDP, preliminary GDP, is not that big of a deal in my humble opinion because it can be revised. But if the market is already waiting for news, Okay, this is now an advanced lesson in sentiment. Because sometimes news is bad news and bad news is good news, and sometimes the news moves the market a lot, and sometimes the same news doesn't move the market at all, and you're like, I don't get it. Well, it's so confusing. Well, you have to put everything into context. What's the context now? If we get a surprisingly half decent GDP number, even though it's some stupid preliminary GDP, the market's already long, and we've gone through this whole process of unbelievably net short, to bottoming out, to maybe the market being less and less and less and less and less net short, which is, what if suddenly now a half decent GDP turns the market from less and less and less and less short to suddenly people buying instead of getting out of their cells? So that could be a higher volatility opportunity to trade than your typical preliminary GDP out of the UK, because of what we've been following the last 10 weeks. Okay? Okay? Consumer confidence, I don't like con. Never did. Because, I just don't like people's opinion. I'll listen to it. Hey, what do you think? Good, tell me all about it, but I'm not interested. All right, because that's their opinion. Put your money in the market, then I'll pay attention, right? So that's why I know COT is a little bit old, a little bit slow, but it's real money in the market. I value that. Some person's opinion, couldn't care less, because half the time they do the opposite of what they say. Fine, whatever. Okay, trade balance is going to be a good one, because why not? Okay, you remember how Kiwi was very, very strong and then flattened out, and now it's turning strong again. And I'm talking about a period of 1 year of strong, flattened out for what, 6 months, and now maybe is moving back up. So again, some good news out of trade balance. Should be very good for the Kiwi. Some people are now nervous, but I get sick of this, right? There's a lot of people in the market that say, oh, it's been bearish, it'll never go up. And then it starts going up, and then they're like, oh, but it's going to fall. It's going to fall here. It's going to fall there. It's going to fall. It can't last. And no matter what you want to do, there's naysayers and doubters and all that. That's why you just have to, block that out with fact. Do your homework. Okay? So if this trade balance is horrible, then maybe the the New Zealand dollar is overbought. But if it's okay to good, game on for the Kiwi. CPI data, this went from not that important to, it's more important recently. It's German inflation, again preliminary, but whatever. We're pumping, or the ECB is pumping all this money into the market. They want to see it work. They want to see good numbers, and so a surprise here could support the euro. But you know what? I think the Eurozone, I think the ECB would like the euro to be at 80 cents, not even parity, because that's actually good. Okay, that's actually on the short run, that'll be really good for the Eurozone, make their products competitive. I mean, imagine imagine a BMW is cheaper than a Yugo. I don't know what a cheap Chinese car is, but imagine BMWs are extremely affordable in America. Americans are just going to gobble them up. On the short term, that'll be really good for the European markets. But there's this other thing going on. Which European countries are benefiting from quantitative easing, and which ones aren't? Okay, so that's going to be a complicated thing down the road, and that even if inflation starts to kick in Germany, the ECB might just have to keep doing it anyways until, you know, other countries start to benefit. You know, one thing might be interesting, just popped in my mind. I don't know if there's any truth to this, but it just popped in my mind. I wonder if you could track the Polish zloty as sort of you know, other European, Eastern European country. Because there's, you know, and say, well, it's hard to like break the Eurozone all into pieces and to find out who's it benefiting, who's it not benefiting. If the Polish economy, I know it's not part of the Eurozone, but if the Polish economy improves and the Polish zloty increases in value because all its trading partners, the rest of the European Union, slash, you know, ECB quantitative easing, you know, if the quantitative easing is helping the Eurozone, it's going to help Poland, right? Is it? All right. Well, Dar says stay away from the zloty. Well, okay. I can't argue that, right? But who knows? If Poland is benefiting from the quantitative easing, then you could say, well, let's say the smaller in the Eurozone might be positively affected by what's going on anyways. All right, fine. FOMC, yield, that's going to be important, all right? That's going to be important, obviously. Again, too many people think that that was going to be the meeting. Now we know it's not going to be the meeting, so it's not going to be the meeting, but they're thinking September now. Whatever. So this is, you know, several months ago, people thought this meeting would be where the Fed raises interest rates. Now the market has decided it's not. So it's the decision's not important, the statement is, okay? And I'm not prepared to go through, like, if they say this, if they say that. Honestly, I don't care. Okay? But we'll pay attention to it, try to learn from it, and wait for the market to decide what they think about it. Because, you know, I can talk about this intelligently and logically all day, but that doesn't matter. What matters is what market participants think and how they react. So I want to learn as much as I can from that statement. I'd like to read the statement. I'd like to read the meeting minutes, you know, right down the road. But I'm still thinking next year. I've never thought this year. Okay, and I've never deviated from that. So so we'll just see what we can learn here. Try not to freak out. Okay. More Kiwi news. I think Kiwi's going to be amazing this week, right? Eurozone CPI. Okay, fine. Obviously, it's not going to be as much as Germany, but fine. Same sort of thing. Like, let's get the data, find out if, you know, if there's any evidence quantitative easing is working yet. You know, I'd actually for terrible numbers here because I want to sell the euro all the way down to 80, but I don't want it to rise to, you know, 115 before it falls again. So, you know, whatever. Let it come out. Let's talk about it. The CAD news, very interesting. I want to see if they're benefiting from. I don't think the recent increase in oil prices from 42 to what, 55. I don't know if that's helped yet. I'm not sure if you're going to see that in GDP, but you know, Canadians are beautiful people, so I want the best for them. So let's, you know, but look at what they're expecting. Negative 0.1 versus 2.4. I mean, it's not going to be a good number, right? But you know what? A 0.5, which, you know, typically would be horrible, might be fantastic. So we've been in this, technically, we've been in this sideways market for weeks and weeks and weeks and weeks. Then we broke out, which was pro-Canadian. Then it came back, retest, and then it looks like it's extending to the downside. So if I wanted something, besides of my kind heart for Canadians, I'd like this to be, you know, a positive number. Close to 1% would be great, and if so, Canadian dollar is going to be ripper strong. And speaking about our correlation idea, then I would look to short USD CAD and long CAD yen, for example. I said look for it. Now, if dollar improve in the CRB, nice. Okay, Japan and inflation. Yep, we want to see if that's working. Most importantly, what I would like to see is more stimulus and more quantitative easing and more from Japan so that we can keep the yen's weak. Here's my guess on this, if you don't mind a guess, and it's more of like my evil twin would say, I want the yens to weaken, but the Japanese are not going to do it. It's going to be a decent number, and then the Japanese are going to come out and say, we're not going to do any more quantitative easing. We're not going to do any more stimulus, and the Japanese yens get strong for a while, and then of course by the time September and October come around, you'll find that they'll change completely and add stimulus and add to quantitative easing. So that's my evil twin saying, you know what, they're gonna strengthen the yen for a while and then they're gonna weaken it. Who knows? I have nothing to back that up. That's just pessimism. Chinese data, PMI, right? Absolutely going to be important. We're struggling to keep above 50. Anything below 50 means their economy is contracting. Okay, and you can last time was 50, or sorry, it's forecast to be 50. Last time was 50.1. Isn't it amazing that it's not 49.9? Now, do you honestly believe the economist can get together, look at all the data, and with any level of accuracy say it was 50.1? And definitely not 49.9? I mean, what's the rounding error? I mean, I have my doubts of the difference between 51 and 50. But 50.1? Yeah, sure, right. But that skepticism is for everything, not just China, but certainly China, right? And you know, end the week with Aussie. Okay, that's going to be good. All right, and especially I want the Aussie dollar increase in value so I can sell it. And then the manufacturing data out of the UK. Okay, fine by me. That's a good way to end. It's sort of like start with the UK, end with the UK. And more Canadian news. So we got a lot going on commodity-wise this week. Tons of Kiwi, some Aussie, tons of CAD. It's going to be very interesting. FOMC and the interest rate decision and policy statements. And oh man, this is going to be great. I mean, just a great mix of important news. And this is only the important stuff. I've filtered out the moderate stuff. So I think we're going to have a fantastic trading week. And I hope you do very well, that you feed your family, squirrel away some savings, and then have some left over for your trading account to grow. So I wish nothing but the best for you. We must run. I'm going to upload this to YouTube immediately. I'm going to drop you onto YouTube if you can watch the last video, or at least leave comment or like the last video. And in 2 hours, this video will be there. Okay? But just leave a comment, give it a like, share it with somebody. I'd appreciate it. So I'm sorry why I went on for, you know, what, hour and 15, hour and 20 minutes. But I want to give you 105%, maybe even 110% every day. And I hope you believe you got that. Peace on earth. May the pips be with you. May your profits be above average. And thank you for Traders Way for making this available to you. Thanks for being a client. Trade your way. A trader's trader, Wayne.